So good morning, everybody. I'm very pleased to be here this morning to speak to you on the topic of CCP supervision and financial stability. With the growth of central clearing over the last years, CCPs, of course, are concentrating more and more financial risks, as you're all very much aware, and therefore CCP supervision is critical in order to ensure that CCPs will not pose risks to financial stability. And this basic consideration, in fact, has been the rationale for the adoption of the European Market Infrastructure Regulation, EMIR, already in the beginning. But of course, new challenges exist, and we're all aware that EMIR is currently undergoing a review, and we hope to soon have EMIR 2 in place. When thinking about the role of central banks in this context, and I'm speaking here today from the perspective of a central bank that is not a CCP supervisor and has no ambition to be a CCP supervisor, please keep this in mind during the course of the presentation. But still, we are very much concerned when it comes to CCPs. And why is this? Well, supervisors can do everything and will do everything to preserve financial stability. But financial stability cannot be preserved without monetary stability. If the large liquidity risks concentrated in CCPs are not well managed, this can seriously endanger monetary stability. And this aspect is what I would like to focus on in today's presentation. And let's see if the slides will work for me. Just on this side.
I'm pretty sure it's one of these.
Okay.
I'm no longer sure.
Okay, we will see. Maybe if we ask the colleagues here.
It's this one here.
Okay, thank you. One down. Okay, so these are the areas that I would like to cover. First, to look at the link between central clearing and monetary policy, focusing on the need to preserve the liquidity resilience of CCPs. Second, I will explain why liquidity risks in central clearing have increased and what is being done to control these risks. And finally, I will offer my views on what this implies for the role of central banks in CCP supervision going forward. Maybe just as a general remark, I would like to note that I'm presenting today an ECB staff view and not necessarily the view that is the formal view of the Governing Council of the European Central Bank or our Executive Board. So, let's see. Very good. So, central clearing and monetary policy. Well, the central bank of issue concerns regarding central counterparties arise mainly from potential situations where liquidity strains could be channeled through centrally cleared markets. Now, CCPs, as you well know, can propagate or generate liquidity risk, either as a result of shortcomings in their own financial risk management or as a result of strains that are occurring in the financial markets more generally and that are affecting their resilience. Such wider liquidity strains can directly impair the ability of central banks of issue to fulfill their core mandate of achieving price stability. And more specifically, in the case of the Eurosystem, there are concrete risk implications for our basic tasks to define and to implement the monetary policy of the euro area and to promote the smooth operation of payment systems. And I would like to look in particular at maybe some of the contagion channels there that we have here. So first, let's look at payment systems. CCP liquidity problems will have direct knock-on effects for banks, and these are banks that are not only members of the CCPs, but are also monetary policy counterparties of the Eurosystem and major participants in the large value payment systems operated by central banks of issue, such as ourselves. Now, however, the smooth, real-time settlement of large value payment flows underlying monetary policy operations is absolutely critical for the effective monetary policy implementation. Therefore, a drying up of liquidity in large value payment systems as a result of liquidity strains in CCPs could actually impair monetary policy implementation. Another important area is the links to repo markets, which again are essential for monetary policy transmission. CCP liquidity strains can disturb the functioning of repo markets, especially through CCP's roles as repo clearers and repo counterparties, and especially in the EU, where repo markets rely heavily on central clearing, and the CCPs themselves are repo counterparties through their reuse of cash and securities collateral. And finally, there is the potential role of central banks as lenders of last resort. Now, central banks may be asked to provide emergency lending, either directly to the CCP, through swap lines, for example, or to banks that are members of the CCPs. Now, when we consider the very large financial exposures that are concentrated in CCPs, central bank liquidity support in these situations could also impact the attainment of monetary policy objectives. Looking more closely at central clearing and liquidity risk. When we talk about liquidity risk, we mean a potential inability of a CCP to meet its payment obligations when due. And this can arise in several key areas of CCP financial risk management. And I mention here the areas of a CCP financial risk management that are of greatest interest to a central bank from its CBI, Central Bank of Issue perspective. So first of all, we have the liquid resources for managing participant default. The availability of a sufficient amount of highly liquid financial resources is absolutely critical to ensure that the collateral held against the default of a participant can be converted promptly in order to ensure that the CCP will continue to meet its payment obligations to other participants in time, thereby preempting wider contagion effects within the CCP. The second area is margining. Here, the focus of central banks is on intraday margining arrangements, procedures for the timely and effective collection of margins, including across currency and time zones, and measures to mitigate the inherent procyclicality of margining. Third, we have collateral requirements, another key area for central banks. The recent euro area sovereign crisis proved that disruptive changes of CCP's collateral haircuts can have a major effect, adverse effect of course, on bond market volatility, thereby affecting the central bank's ability to transmit monetary policy impulses. It can also affect the liquidity position of clearing members by requiring them to provide additional margin. And, as in the case of margin requirements, central banks of issue are concerned in particular with ensuring that collateral policies are stable and that they are predictable throughout the economic life cycle. We also have an interest in settlement policies. CCP channel huge amount of payment flows each day, especially those related to margin payments of clearing members. The transmission of these flows rely critically on the robust functioning of the embedded settlement arrangement of a CCP. So again, here we're talking about large amounts of cash going through the payment systems that are critical for central banks. And last but not least, we have an interest in CCP interoperability arrangements, because these may also give rise to liquidity risk in large value payment systems and securities settlement systems which settle in central bank money. And for the euro system, we think of possible contagion effects that might arise for our Target 2 large value payment system or our Target 2 securities settlement platform. So staying still with the topic of liquidity risk, it's clear that the liquidity risk in central clearing has increased greatly in recent years. This is due not only to the larger values that are being cleared, but also to the extended scope of products that are being centrally cleared. In particular, with the introduction of the mandatory clearing for OTC derivatives, this has brought CCPs into a space which, by definition, they're looking at or dealing with products that are more bespoke and less liquid. And this implies, for example, that it may take longer and be more difficult to successfully liquidate collateral when needed, or to close out the position of a defaulting clearing member. Furthermore, OTC derivatives trading is particularly concentrated in a limited number of major international banks. So against this background, the requirements for CCP's ongoing liquidity risk management were significantly enhanced in the CPMI-OSCO PFMIs, the Principles for Financial Market Infrastructures that you are all well aware of, and were subsequently embedded in EMIR in the EU. But more needs to be done. And focus here on two particular areas where we think there should be especially more done. The first is cross-border stress testing and crisis simulations. Recent assessments of CCP interdependencies by global standard setters have highlighted that especially the major global CCPs are highly interconnected and interdependent due to their reliance on the same major banks. Now, these major banks are participants as clearing members. They are also investment and settlement agents. They provide common funding arrangements. So we have the same major banks being involved in different roles with all CCPs. So against this background, it's not sufficient to stress test liquidity risk resilience only for individual CCPs on a standalone basis, but we need to have a broader, more focused cross-border stress testing and crisis simulations to capture these dependencies in the central clearing network. Second, we need to enhance preparedness for extreme events in which a potential CCP or recovery or resolution would be required. Now, recent CPMI OSCO work has highlighted that more needs to be done to address potential liquidity shortfalls during CCP recovery. Furthermore, CCP resolution will also require dedicated liquidity arrangements during a transition period until the CCP has fully restored its matched book. But CCP resolution planning has only just started. Also in this regard, cross-border action will be needed, initially at least at the level of crisis simulation exercise, and in the medium term in dedicated stress tests. And finally, central banks of issue and CCP supervision the way forward. So the liquidity risk that's inherent in central clearing has direct risk implications for monetary stability, and this has increased over time. In line with these observations, central banks have been closely involved in the work to ensure that CCPs control their liquidity risks effectively. For example, the Eurosystem has contributed actively to the development of CPMI OSCO standards, as well as to the development of the EMIR technical requirements. The Eurosystem has also been a member of the EMIR supervisory colleges for all EU CCPs, which have a relevant business in the euro currency. And through this participation in the colleges, we contribute to the ongoing risk assessment of CCPs. So maybe one might think, okay, against this background, is there really a need for further action? However, I would argue that there is, and this is particularly the case when we look at three areas. And first, and the most pressing concern, I would say at this point in time, is the imminent UK departure from the EU, Brexit. So there will be significant challenges in controlling risks arising from offshore euro clearing after Brexit, and we've all seen the estimates in the press. UK CCPs clear approximately 90% of the euro-denominated interest rate swaps of euro area banks, and around 40% of their euro-denominated credit default swaps. So this is quite a substantial amount that will be ultimately cleared in an offshore CCPs in the future. Now, the current EMIR third country CCP regime is very poorly equipped for addressing these challenges. And while we currently engage with UK supervisors in the EMIR college context, and we have a very good cooperation with the Bank of England, and we have a very close involvement, but this will change in future with Brexit. We will have no legal basis for this closer cooperation, and we will also, of course, lose the jurisdiction of the European Court of Justice. So this development is why we support the European Commission's proposal to introduce enhanced supervisory requirements for systemically relevant third country CCPs, and to include potential central bank of issue requirements in this new framework in line with the monetary policy mandates of central banks. We also welcome the plans to involve central banks of issue in the ongoing supervisory review of the relevant CCPs, both to ensure effective central bank access to relevant information and to allow for close information sharing and dialogue with supervisors during their ongoing assessment. The second area for further attention, in my view, is the need for adequate central bank involvement in future cross-border simulation and stress testing exercises that I referred to before. So given their role as monetary policy authorities, central banks are uniquely placed to contribute to liquidity-related stress scenarios. And we already cooperate with ESMA for the EU-wide stress testing exercise. And in our role as central banks, we focus in particular on the liquidity stress testing element there. We've also contributed to the work of CPMI OSCO in developing a supervisory framework for stress testing for CCPs across multiple jurisdictions. The third and final area we need to further think about is the role of central banks in CCP recovery or resolution. Liquidity pressures would be particularly pressing in these situations, as CCPs would no longer have access to pre-funded resources. And the extreme funding pressure associated with position and loss allocation in this type of situation, and we have to remember this type of situation is most likely also coupled with market stress, this could have very material implications for the role of the central banks as lender of last resort. In order to minimise any related moral hazard, the further tightening of the CCP's own liquidity risk controls, including for extreme market events, will be the main priority. And in this context, it will be critical to enable CCPs to effectively identify and address CCP liquidity risks throughout their potential life cycle, from ongoing supervision to potential resolution.